Welcome to MexMoves, our weekly podcast on Mexico business and finance. How are you, Eduardo?
I'm doing well, Damien. How's everything?
Good. So this week we talked with Gerardo Lozoya. He's the head of investor relations and public affairs at ASUR about the restaurant giant behind brands like Starbucks, Domino's, Burger King, Vips in Mexico, much of South America, Europe, Spain, France, Portugal, among other places. And we look at their current results, which have been very strong. In fact, the stock was up almost 20% last week after a very good second quarter. And above all, what's next for growth in Mexico and abroad. We're going to look at Mexico's GDP for the second quarter, and then some more US-Mexico cross-border deals. Live Nation increasing its stake in OCESA, Liverpool giving some more details on its investment in Nordstrom, and ASUR, at the Cancun airport operator, buying retail operations in LAX, JFK, and O'Hare, and Nemak, the Mexican auto parts company, also making a big acquisition outside Mexico. So that's what we have this week. So Eduardo, the news of the week, I guess, is that there isn't news. Trump, as you probably saw, announced that he and Mexico Scheinbaum have agreed to extend, to quote his Truth Social, for a 90-day period, the exact same deal as we had for the last short period of time, namely that Mexico will continue to pay a 25% fentanyl tariff, 25% tariff on cars, and 50% tariff on steel, aluminium, and copper. What he didn't say, but it's implied, is that Mexico won't pay any tariffs on USMCA compliant goods, is potentially about 90% of Mexican trade. And he also said, without going into any details, that Mexico agreed to immediately terminate its non-tariff trade barriers, of which there were many. So we'll see what that means, if it means anything. And to refer to that, in her tweet, she said that it was very encouraging and that they were going to work together in this 90-day period on a more kind of comprehensive agreement. It doesn't amount to much because Mexico was paying 25%. Then Trump threatened it on the non-USMCA goods, compliant goods. Then Trump said it would be 30%, so it's only a 5 percentage point increase. And then they reached this deal to cut it to 25, which is where it is. And then Mexico, of course, is paying the 25% on some USMCA compliant sectors, auto parts, for example, which is a big export business for Mexico, and steel, which is up to 50%, and aluminium and copper, although it seems it's not going to be the underlying copper, but copper kind of based products. So overall, Mexico isn't in a very different situation as it was. The threat of a 30% isn't a big difference. And we're basically kicking, as I see it at least, we're kicking the can down the road for another 90 days. And it was obviously way too short period of time to renegotiate USMCA. If you compare what Trump said about Mexico with Canada, maybe Mexico's in a better position, because I think he also said today that he didn't see a deal with Canada because it was considering recognizing Palestine as a state, and obviously the US doesn't have a deal with China today, won't have a deal with China, as it already said. So actually, August the 1st isn't quite as important as perhaps Trump sort of said himself, because he's not going to have a deal, as far as things seem today, with the three most important trade partners of the US, Mexico, Canada, and China.
Yeah, I mean, I think if in 90 days we get a deal and the USMCA or the UMA is saved, it's good. I mean, I think the only one that worries me the most is 25% on autos versus a 15% tariff that Japan and the European Union
on auto parts, right? Because autos won't be paying the tariff. It's auto parts as things currently stand.
Okay. So autos are off from any...
Well, no, that's a sort of understanding before today that autos were off and auto parts were on. But there's so many moving parts and so many different people saying different things. But yeah, it would be, as you're right. If Mexico's paying 25 even on auto parts, and Japan's paying 15, EU's paying 15, that's problematic.
Right. And then the other thing that worries me is these non-trade barriers. What does he mean by that? I mean, some people are already interpreting it as drugs barriers. In other words, the links between government officials and drug organizations. I don't know, because non-trade barriers, I don't know if does Mexico have any, or where are they? Or maybe the oil industry, the energy sector?
Well, there's corn, right? So Mexico has sort of banned, quote unquote, GMO corn. I guess is a non-trade barrier.
That was solved. No, they would be able to import GMO corn, but not the seeds or something, if I recall
Yeah,
correctly.
but I think Trump can sort of say that to the Iowa farmers that you can now have it enshrined in a sort of trade agreement,
I see.
or in
Yeah.
a it's sort of the Mexico's trade deal with the U.S. is subject to that, and oil might be another area that people would argue that there's a bias towards the state-owned entity, of course. So energy in general, I think it's probably a lot of sort of rhetoric. I don't think Trump himself is that familiar with these issues in a way he could be, he or anyone else for that matter, who's
I
got.
was gonna I was gonna say that. I mean, he uses the phrase because it sounds technical and sophisticated, and somebody probably told him so. But I don't know. He understands
On
exactly what it means.
telecommunications, AT&T has been complaining a lot about
That's true as
unfair
well.
competition
Yeah.
from American Mobile, and they have some legal arbitration going on. So AT&T is obviously a powerful voice in Washington, so maybe they're pushing Trump to
They're
limit
pushing
a
things like
deal
those.
on that. Like the US, actually, Mexico also has some barriers on foreigners owning TV licenses and things like that. I suspect that those will. I'm sure those will stay, but and no one wants to be in TV anyway. Streaming as well.
The markets reacted well, no, Damien?
Yeah,
Or
I
the
think so. I mean, I think there was this kind of lingering fear that maybe there would be some baseline tariff on USMCA compliant products, which would have been disastrous.
that would be a radical. Yeah,
Not only because you're paying the tariff, but because these goods cross the border so many times, it adds a lot
exactly.
to complexity. And once you have a tariff, then it's easy to put it up. And next time there's a drug problem or a money laundering problem. So the fact that there's an extension, the fact that the language in the Truth Social post and Scheinbern's post is so encouraging and friendly and positive, all of that indicates that things are going on in the right way. And since the vast majority of goods are USMC compliant, and 25 versus 30 isn't much of a difference, I think people are kind of relieved that things are moving in the right track.
In the right. I mean, we've talked about that the markets don't like uncertainty, but this uncertainty is welcome in that sense, that because it has this, like you said, this positive spin because of the language, the body language even of Claudia in the photo that she put on her tweet is.
Yeah, I mean, if you have a gun at your head and you're told you actually you have another 90 days to live, you'll be quite happy with the uncertainty.
Exactly. The danger, the uncertainty, all is welcome news before you're dead. Well, yeah,
Great.
correct.
Well, let's move on to the next subject. Eduardo, why don't you kick off with your thoughts on the second quarter GDP?
Yeah, sure, Damien. Well, it was a big surprise as we all have been looking at the numbers. Mexico grew 0.7% in the second quarter from the first quarter. The latest polls for the quarter already had shown an increase, but it surpassed the 0.5 polling estimates that were recollected prior to the number. In annualized terms, that's a 2.7% growth rate for the quarter, very similar to what the US also has reported. And it showed the resilience of the Mexican economy. I think this is my initial analysis. I think it was particularly surprising because the external or the export and import sector proved to maintain a solid momentum especially during the last month of June, where exports grew 10%, if I recall correctly, and imports were a little bit further below. So, and this all coming despite tariffs and uncertainty on many issues. So I think as we saw Claudia Sheinbaum, Mexico's president, yesterday, being very pleased with the number. It surprised and it showed that all the headwinds that we were expecting, with the exception of Gabriel Casillas, who we interviewed a few podcasts ago, didn't materialize. I don't know if we can call this a victory and the rest of the year will be on the same pathway. I don't think so, but it does show a certain resilience of the industrial and service sector because the agricultural sector did decline. And it's all good news. Not everything is working well for Mexico, but at least in terms of growth, this was a more than welcome number. Private unemployment is still very depressed, but we'll have to wait and see what the future holds. But this number at least gave a breather, I would say. What's your take, Damien?
Yeah, I think that it's possible that there was some kind of acceleration of exports ahead of tariffs that might have sort of facilitated GDP in the second quarter, somewhat artificially. But we've also seen that the U.S. economy was surprisingly strong. 3%. It's a different way of measuring it, but 3% over that same period. So on an annualized basis, so that probably helped Mexico. Mexico is proving a bit more resilient, and it's quite possible that Mexico, as we saw under Trump, first time round, will be a net winner, as we've talked about a lot, from all these tariffs. If Mexico gets lower tariffs than the rest of the world, and that might be kind of facilitating investment in the country. But it's a good figure. Do you? I think you wrote a story that was published in the Guardian, Eduardo, this week, somewhat negative on Mexico's outlook based on kind of investment being hurt by Trump's tariffs and by the judicial reform. Anything you'd like to reconsider, or do you stick with that?
No, I am sticking with it because the main focus of that story was investment. And I think the numbers on the investment that is taking place in Mexico are still not as solid as they could be. And I think that's a big concern for the future of Mexico's growth. It doesn't necessarily impact growth as we speak, but if you don't invest in new factories or people are holding back, if new foreign direct investment does not come into the country, new one, not the one that keeps maintaining the running the operations that are already in place, I think in the future that could hurt Mexico. Yeah, it was negative a few days just before these numbers, so we got a little bit of a black eye, but we'll wait and see. We'll have to wait and see. I'm glad that I was wrong, or will be glad that I will be wrong in the future if investment picks up again sooner rather than later.
So we can move on to this OCESA Live Nation deal. As many of the listeners will know, OCESA is Mexico's dominant live events operator, organizing concerts, festivals, cultural events, theater. It's done recently U2 concert here, Taylor Swift, Coldplay, Red Hot Chili Peppers, Arctic Monkeys, The Cure, Madonna. Pretty much every major concert in Mexico is organized by OCESA. And back in 2021, Live Nation, after an initially quite sort of contentious deal that got cancelled due to COVID, and there were lawsuits, and then it re-happened, as it were. Live Nation back in 2021 took 51% of OCESA, buying out Televisa's then 40% stake, and took an 11% from CA, the listed Mexican entertainment business, which until this transaction had 49% of OCESA, previously having had 60%. So CA goes down to 25%, and Live Nation goes up to 75%. Now, since 2021, OCESA's done really, really well. This deal values 100% of the company at $2.6 billion. When Televisa sold its stake, the value of it was about 800, of 100% of it was about 870. So you've seen the value go up, threefold. Unfortunately for Televisa, another example of perhaps getting the timing wrong when it was selling a a key asset. If they'd held on, they might have got a lot more money. And CA will get this cash flow from the company that owned 49%, will get this cash to reduce debt and invest in new projects. And Live Nation in their press release said that Mexico is now one of the 3 largest markets in the world for live entertainment for them. So that's it's pretty amazing. And I think if you see the price of tickets to go to these concerts and the size of the stadiums, which are gigantic, it's perhaps not that surprising. Mexicans love live entertainment, and it's another example of the convergence in entertainment, at least between the US and the Mexican market. Have you been to any of the OCESA events? I'm guessing you've at some point you've been perhaps to Formula One or something like that.
Not recently, but I have, and I was a big admirer of OCESA because it was, and CA, it was the company that really brought live entertainment to Mexico in a professional, high-quality way for the Mexican audience, who were very eager to listen to all their famous pop stars or rock stars. And I think they did a fantastic job. I think they got into a little bit of trouble because of the amount of debt that they had, and that probably made CA inclined to sell a portion of OCESA. It was, and it's always been a very well operation in terms of all the offerings that they do. I mean, I've been to the Formula One a couple of times. I've been to a couple of concerts, and it's very well run. So I'm not surprised that Live Nation in the end decided to increase its stake in a company that offers that the quality, and the bottom line is it shows that it's quite profitable. So we'll have to wait and see what CA does with the money and how it revamps other operations that it has.
Yeah, and under the deal, Alejandro Soberon Curi, who's the founder of OCESA and CA and the CEO of CA, will stay on as OCESA's CEO until at least 2032, and he has an option to sell the remaining 20. Well, his company has an option to sell the remaining 25% at that point. So it also gives more time for OCESA to continue to be run by Soberon, and he's obviously done an excellent job both founding the company and then running it. It's not trivial managing live music, especially in Mexico. A lot of regulatory stuff, a lot of political contacts and relationships, which obviously he has. So he's key to the value. And that's why Live Nation has kept him on for another 7 years, I guess.
Yeah, I think there's no one like Alejandro who knows the key players in that industry and has the team to continue doing what they've done very impressively well over the past decades. No.
And well, there's another cross national investment, ASUR. In this case, is from Mexico to the US. ASUR, one of Mexico's top, as you know, largest airport operators, runs the Cancun airport, listed both in New York and in Mexico stock market, said it was acquiring URW Airports, which is a commercial management firm operating shops in terminals at LAX in LA, JFK in New York, and Chicago O'Hare. They're paying about $295 million. So it's a pretty big investment. And I think I'm guessing that ASUR's doing it. They face partly because they've been diversifying out of Mexico. They bought airports in the main airport in Puerto Rico recently, well, not so recently, but some years back. And Cancun has slowed down a lot, as we talked about in a previous podcast. Cancun definitely this year is suffering from competing tourist destinations. So this is a way of reducing the weight of Cancun in the ASUR operations. Also, these airports are important to ASUR's Mexico airports. The three, LAX, JFK, and O'Hare, account for about 12% of international travelers flying into ASUR's airports. So having a good relationship there is a way of keeping, I guess, establishing a relationship with your customers, both in Mexico and in the US. And it will, I guess, give them a lot of kind of traveler data, better bargaining power with global brands when it comes to leasing retail space. You can give them, JFK, LAX, O'Hare, Cancun, Puerto Rico. You're in a much stronger position than if you're just running a few airports in Mexico. this isn't about running the terminals; it's just concession spaces. But it's another example of big Mexican companies that generate a lot of free cash flow here in Mexico, expanding to become global operators.
Yeah, it's another company that's grown global. I mean, they have also operations in Colombia, if I recall correctly. And with this transaction, for those that travel and they might start seeing some changes or not, they will be controlling the commercial spaces in terminals 1, 2, 3, 6 of the Tom Bradley west side of the LAX, as well as Terminal 5 in O'Hare in Chicago, and Terminal 8 and Terminal 1 in JFK, not Terminal 4 where Aeromexico flies to in New York City. So, yeah, they're expanding. I don't know if the valuation, I don't know how to assess how much is $295 million for those retail spaces in those terminals, Damien. But I'm sure the management was careful enough not to overpaid, and will gives it a larger basket of goods from where it will derive its revenue and profits, I'm sure.
And probably a bit of upside, because at least based on my experience, the shopping opportunities in JFK especially, and the overall kind of look of the airport, isn't great, and so there might be ways of extracting more money.
Airports have become shopping malls, my friend. I mean, I was in Washington for 10 hours in a delayed flight not so long ago, and the new terminals there and the trains and the systems and the lounges, it's very impressive how they've become shopping malls, basically. I don't know how much people do shop, but I guess they do. Otherwise, why would they be there? And so the entertainment, the food, everything. And I got to say, it's not cheap. So I guess, yes, there's a large upside for ASUR. And they've done well in that part of the business, in Mexico. So they know how to do it.
And then, Eduardo, another Mexican company expanding abroad, Nemak, the Monterrey-based auto parts manufacturer, which already has auto parts operations around the world, announced a $336 million acquisition of GF Casting Solutions, basically to position it in lightweight, some next generation electric, in many cases electric vehicles. It's pretty cheap, based on what I understand. They're paying 3.6 times EV/EBITDA, and there's quite a big deferred element. They're getting 9 production plants across Europe, China, and the US, an R&D center, and a product mix that today is about 80% e-mobility chassis and structure and 20% on other components. So clearly they're pivoting to electric-driven cars with this acquisition and diversifying away from their more traditional business lines.
Yeah, this transaction to me has 2 very interesting elements, Damien. First, I mean, you and we've talked about potential risks for Nemak with the tariffs. Like I just mentioned before, with the economy, it has proven to resilient. And Nemak has said that they're doing still well despite all the troubles or the tariffs to export. Again, it does highlight how companies are overcoming some obstacles that are being presenting to them. And the other one is how, despite Trump's, how could I put it, antagonism towards electric vehicles or hybrid vehicles, it seems that the trend is here to stay, despite what a politician might think he wants the world to look like. I do own a hybrid vehicle, and it's quite amazingly efficient. So, and I think that's the way the world is going to go. Not necessarily totally electric, but eventually that's where I think we will move. But it does show that Nemak is betting on the future. It's betting that the trend towards lower emissions, a more sophisticated way of mobility using electricity will remain and will be here in the long run. So to me, it shows the resilience of the company and how it's looking forward despite headwinds.
Yeah, I would agree with that. Another investment which we already knew about was Liverpool's 49% stake in Nordstrom, which was quite a controversial investment. I don't think the stock market particularly liked it. Generally speaking, the stock market doesn't like companies using their cash to sort of take minority stakes elsewhere, especially when they're being minority, they're not going to consolidate it. And in the second quarter earnings call, they gave a little bit of additional detail how that's going to work. 3 board members will be appointed by Liverpool, 3 by the Nordstrom family, because the purchase of 49% was concurrent with the Nordstrom family taking the other 51% and taking Nordstrom company private. And then there's 1 board member that will be jointly selected. And all major decisions have to be jointly approved, so that they have, it seems fairly good governance protection, despite, having a minority, one short of the 50%. And they said they're not bringing Nordstrom to Mexico. There's some speculation that with this deal, they might bring Nordstrom to Mexico. Nor are they taking Liverpool to the US, which was another thing that was speculated. Instead, they're going to be learning from Nordstrom's expertise in e-commerce and loyalty programs, and perhaps the other way around, because Liverpool's done a great job in e-commerce in Mexico. They'll be getting some exposure to private label and Nordstrom sort of brand access and pricing terms, perhaps. And they'll also be learning from them and vice versa on logistics and overall on digitalization, the business. And they are expecting dividends, about $17 million in the second half. So we don't know the exact investment. It was probably about $3 billion. So the dividends will help defray a little bit, at least, the interest costs on doing that. Now, it happened when Liverpool reported somewhat weak results in Mexico. Same-store sales were a bit below the ANTAD numbers. Gross margins fell a bit. EBITDA was also down, and margins were down. And so again, I think, leaving aside it from Liverpool's perspective, at least being a potentially attractive investment, I think it's also part of this strategy of Mexican companies diversifying away from Mexico by using their cash to get access to other places. And with this kind of slowdown in the second quarter, which was not specific to Liverpool, also FEMSA reported weak results in Mexico, especially at OXXO. Walmart a couple of weeks ago reported weak results. You saw big falls in FEMSA and Walmart's stock price following their results. So the consumer overall was quite weak. I'd say, which we're going to talk about in a moment, was an exception. But it seems as if they want to take some money off the Mexico table, and they've got reasonably good governance protection, even though technically they're just below the 50%.
Yeah, I mean, I think and I understand why investors have not liked the deal, because mainly digital retail in the States has taken over quite heavily. I assume that's one of the concerns, that they're buying a brick and mortar operation that makes little or has little future growth. I don't know, but it's an interesting bet by Liverpool. I'll give them the benefit of the doubt. Let's see what they can do with their new position in Nordstrom. Like you said, maybe the expertise will fly from Mexico to the States rather than from the States to Mexico. Like it's the natural cause, and they might be able to turn around Nordstrom. I don't know. In a much larger market. But it's an interesting bet. The companies you mentioned that didn't report well, surprises, because also, we just saw the economy doing well. So that's why I think the export sector was the driving force for this past quarter in terms of the macroeconomic picture. And in Liverpool's case and others, they reflected a consumer that was less willing to spend the past 3 months.
Also, I saw today, Eduardo, changing tack to the financial sector, something we've talked about before. In white paper, they mentioned that, BBVA reported its second quarter results out of Spain, and in that report, they highlighted that BBVA Mexico made 2.6 billion euro profit in the first half, which was 44% of BBVA Group's total global earnings. Pretty amazing. So they're on course to make maybe $5.5 billion euros out of Mexico, which is an extraordinary number. And because of Mexico, they're revising up their full year global outlook, and also, largely because of Mexico, they have potentially as much as 13 billion for dividends or share buybacks. They have excess cash, and at the same time, New Bank reported its June numbers, and therefore we have second quarter numbers, and they still have an awful lot to do. Their net loss in the quarter for the second quarter went to $41 million from a net loss of $28 million. So they're still losing, obviously, a fair amount of money. And the main reason is that they have way more deposits than loans. The deposits are still paying above the government interest rate, so they're effectively losing money on the deposits. And the loans, although they're picking up, loans are up 13% quarter on quarter, they still have a high cost of risk, which is about 25% in the quarter. That's the NPLs plus the write-off. So they haven't quite got the model working yet on lending profitably. I think with a cost of risk of 25%, it's difficult to be very profitable, even with the interest rates they charge.
Yeah, the banking sector. It seems like the incumbents are still raking it, while the newcomers are still struggling, and the field is there for everybody to adapt, I guess. But BBA has been doing tremendously well in Mexico for years. No wonder they have a skyscraper in this city. That is quite impressive.
And to wrap up, Eduardo, I thought it'd be a good idea if we wrapped up with sort of stories we liked in the foreign press on Mexico business. Two that struck me. One was the story over the weekend in the Wall Street Journal. Absolutely brilliant story. One of the best I've read this year, maybe in many years, on how Ricardo Salinas Pliego, the controversial billionaire, founder of Azteca, Electra, and so on, was scammed out of initially $400 million in a sort of loan scheme. And this, he was preparing a major Bitcoin investment, which if he did it in 2021, he made a huge amount of money from the Bitcoin part, but maybe lost some back by he gave into this group of Russian investors who masqueraded as ASUR Capital Fund. He gave them $1 billion of Electra stock as a guarantee for the loan, and then they secretly sold that Electra stock and didn't give him the money. A lot of that money has now been frozen, so the actual losses may be a lot less than $400 million. And if he put the money he did receive from them in Bitcoin, maybe he even came out ahead on the trade. But it's a completely fascinating read. And another story in the New Yorker, they profiled Los Algodones, which is, as you know, a Mexican border town near Arizona, which is known colloquially as Mola City. It's got the highest concentration of dentists, and the story talks about how over 1 million Americans every year go to Mola City to get their teeth sorted out. Have you ever been there, Eduardo?
No, I've never been to Los Algodones, but it now sounds fascinating to go see all these dentist shops there, I guess. But let me tell you a little anecdote that I had here at home. I mean, I do have an Airbnb in my place here in Mexico City. And at some point, one of our guests came to the house to where the Airbnb, and she said, "No, I won't be making it on time because after I land, I'm going to this dentist shop near the airport." And you and I know that the airport is not necessarily the nicest neighborhood in the country. And then I was intrigued, so I asked her, and she said, "Well, it's a very well set up place for all these tourists that land, and they have their teeth clean, fixed for half the price of what they pay in Canada or the United States, near the airport, in this one of these neighborhoods that it's a working class neighborhood, nothing wrong with it." And I was shocked. I said, "Are you sure you're gonna get your dental work well done?" And she said, "No, I mean, I've seen the reviews, I've seen all the postings, and everybody speaks wonders about the doctors and the medical care, the dentist care. So So there you go, Damien. We just did a podcast on hospitales. We talked about dentistry, now algodones, and the airport as a health hub for your teeth in Mexico.
Well, as someone with British teeth, maybe I should be going there.
I'll get you the address. Then we'll have you recount the experience, the anecdotes.
Today we're joined by Gerardo Lozoya, Director of Investor Relations and Corporate Affairs at ASUR, Latin America's leading multi-brand restaurant operator, based in Mexico but with operations around the world. ASUR manages a portfolio of iconic global brands including Starbucks, Domino's Pizza, Burger King, and most recently Chipotle Mexican Grill, alongside its own concepts, including VIPs. Gerardo oversees ASUR's communications with investors, with regulators, and the public across its diverse markets, from Mexico to Spain, France, Chile, Argentina, Colombia, and beyond. ASUR recently made headlines with a major franchise agreement to bring Chipotle to Mexico, and a move that's considered bold, given the challenge of introducing Americanized Mexican food to Mexico itself. Gerardo, how are you today?
Hi, Damien. Thank you for having me.
It's a pleasure. Gerardo, ASUR has excelled at operating U.S. franchise brands like Starbucks, Domino's, Burger King, and now Chipotle in Mexico and then Latin America and Europe. What do you think is the key to your success in adapting these brands to local markets? Is it operational efficiency, brand management, getting on with your global partners, or another competitive edge, or a bit of all of that?
I think, Damien, all the things that you mentioned makes us a very, I would say, strong company. Since the beginning, I don't know how familiar are the people with Alsea, but it is a company, I would say, that is pretty young. It has been in the market for 35 years, and we started with a Domino's Pizza in Mexico City. And then I would say the rest is history. Now we have almost 4,000 stores in 12 markets with 13 brands. You mentioned a couple of them, Domino's, Starbucks, but we do also have Burger King. We do have Chili's, Cheesecake Factory, PF Chang's. So I would say we are very good in how we operate things, kind of the processes behind everything in every restaurant, in every store. That makes us, I would say, different from others, Damien. But definitely we cannot be in this alone. Our relationship with our franchisors, such as a Starbucks in Seattle or kind of in Domino's in Ann Arbor, we've been building a very strong relationship with all of them. So I would say partnering with them, talking with them, sharing best practices with them also makes us, I would say, different from others. And I would say we are very good in how we operate things. We want to have proven brands in our portfolio. We have tested in the past our own concepts, our own brands, and I would say we haven't been successful over the time or over the history, but we have been successful in managing these type of brands. I would say, for example, in Mexico, we control our supply chain. We do, I would say, the doughs of the pizza ourselves. We do the logistics to all of our stores. We visit 2-3 times a week each of our stores, each of our restaurants. That's something that I would say not everyone can do. We do have, I would say, leverage and also synergies within the concepts and within the brands that we operate. So it is all together, Damien, that makes us a very, I would say, strong company, and that we are here for the future and for the long term. It's not something that we want to keep for a very short period of time. We want to keep our brands, our relationships for the long term. So it is a bit of everything that makes us different from others. And I would say the culture also of Alsea. It's a very, I would say, active culture that I would say the founders have been implementing in the past 35 years. It's a very robust team that we have in place. I think those are the things that makes us, again, different from others, and that we have been successful over the past 35 years, Damien.
In this week's Starbucks conference call, they talked about Mexico being an area where they're doing relatively well, in contrast to some other parts of the world, where, including the US, where Starbucks has suffered a bit lately. Why do you think Starbucks Mexico has been a sort of exception to the Starbucks global issues?
Yeah, I think that's a very interesting question. It's been a little bit different from the past years, Damien. We operate as if it's day one, always. If it's a Starbucks or if it's Domino's or if it's another of our brands. And I would say that is different from others, because if you look at our stores in Mexico and you drive, I don't know, Mexico City, but also you go to Monterrey, or if you go to Cancun, or if you go to any of the kind of the cities where we are present in a Starbucks in Mexico, you will find, I would say, the third space or the third place intact. You have the stores very well accommodated. You have ACs, you have Wi-Fi, you have nice furniture, you have the people, our baristas, very friendly, welcoming once you enter to the store. And we have been, I would say, listening to our customers as well. So again, we've been doing this for, I would say, since day one, since 2002, when we built our first store in Paseo de la Reforma. And today we have almost or more than 900 units in Mexico. So I think we haven't lost, again, kind of the objective and how and when Starbucks was founded back in the days. We continue to operate again as if it's day one. So that is something that I think in other markets it's been a little bit different. Also, we want the people to be at the store. There's something that the US has been pushing over the years, and it's changing a little bit now with Brian under their control. But the MOP, the mobile order and pay application, and how kind of people are ordering through this app and taking it out. And sometimes in big cities in the US, it's probably 50-60% of their sales. And there's no sitting availability. It's kind of becoming a little bit more like a commodity, and we don't want to shift into that, I would say, occasion for the consumer. So I think that is, again, something that makes Alsea, I would say, the regions of Alsea different from others. Also, I would say we've been taking a lot of advantage, I would say, of our very strong, let's say, market competitive landscape, Damien. We are the number one in Mexico. We basically, I would say, build the culture of coffee shops in Mexico when we built, again, in early 2000s, the first Starbucks store. So that is also different from other markets where I would say competition, it's a little bit more stronger, or it's been there for many years. So we need to take advantage of this. We need to leverage. And again, we listen to our customer, to our consumer, and we bring the drinks kind of hot or cold. I would say even the food that we offer, I would say adjust to the local customer flavors. That's for Mexico, but that also happens for France or for Spain or for Argentina, where you can have, I would say, a very nice lunch in our stores. So that is something, again, that makes us a little bit different, and that I would say has been proving that we've been having, I would say, a robust financial results in Starbucks. Yes, we have been decelerating somewhat over the past couple of years, but I would say after the pandemic, we saw a very nice recovery in this brand, and we've been talking to investors and to other, let's say, stakeholders that Mexico should be, let's say, going through a more stabilized let's say, growth. We were growing double digits for almost 3 years in a row. Now we are in the, I would say, mid-single digit same-store sales growth, which I would say it is something that we should be targeting also for the medium long term. So I hope I answer your question, Damien.
Absolutely. And Gerardo, moving on to Chipotle, how are you going to sell sort of Americanized Mexican food to Mexicans? How are you going to position the brand? Is it mainly going to be, I mean, there are 1 million Americans who come to Mexico every year or more for tourism and spend a lot of money. Is it going to be focused on Americans, younger Mexicans? To the extent you're able to talk about it, because it's obviously very new, what's the plan for Chipotle, and how are you going to win over the skeptics from the Mexican purists?
Yeah, no, that's a question that we receive almost on a daily basis when we talked about Chipotle. And it's an interesting one, Damien. We're betting, again, it's a proven brand in the US. It's one of the most profitable brands in the US today. It's a very attractive brand. I would say when we do the analysis, again, we want to have our the best brands in our portfolio. Today is Mexico, but hopefully someday, if we get it well in Mexico, we can export that brand into other markets where Alsea operates today. I would say we were in conversations with Chipotle for many years, Damien. Back then, when Brian Nicol was kind of leading the company, we were already in conversations with them. And then, things kind of evolved in the right direction, and we're going to be the second partner outside of the US of Chipotle. After Alsea in the Middle East, Alsea is going to be the second partner in their, let's say, international adventure for Chipotle. We're not trying to sell Mexican food to the Mexicans, Damien, because if that is going to be I would say the way of working, we're going to lose 9 out of 10 times. There's a lot of taco stands in the street. There's a lot of fondas. There's a lot of, I would say, local food in Mexico, as you know. It is not that way how we are thinking we're going to win the market. It is going to be the first fast casual dining in Mexico. So I would say, and it is not also something that we're focusing on kind of the tourists or the millions of Americans that come to Mexico every year. It is for the Mexicans as well. And it is not just tacos and burritos. That is, I would say, the perception that today, I would say Chipotle is having, but it is also bowls. Bowls is a very large, I would say, part of their menu and the revenue stream. And it is a very high, I would say, protein-driven lunch, rich in proteins. I would say a little bit healthier option in the market. So we're not, again, going to position ourselves as kind of a Mexican food offering. It is more of a fast casual dining, rich in proteins, healthier, for kind of new generations that know the brand from the US, that are willing to have it. And just a kind of a fun fact, I was doing kind of a poll with my friends in the north, in Monterrey, and roughly 70% of them were willing to go and eat in a Chipotle twice I think twice or 3 times a year. So if that is, I know we can extrapolate that into all of Mexico, but if we have that success in this part of Mexico, and then we are able to transport that into the center and south of Mexico, it would be a home run. And also, let's say if it doesn't work, I think Alsea is now in the position to make these type of bets. If we are not successful, we might be spending, I don't know, $10 million for this, again, bet and this brand in Mexico. So again, it's a very conservative bet, and we do have all the potential. We have all the upside. And again, if we do well in Mexico, hopefully then we also can do it in other markets of Alsea.
Gerardo, let me ask you and maybe help you with the challenge that Chipotle has for you guys. in terms of Mexican food for Mexicans. But is it true that, or have you seen from your experience in what happens in other countries, that Mexicans are more inclined or have a greater love affair with U.S. brands?
No, and hi, Eduardo. Yes, of course. I think we Mexicans love American brands, Eduardo. And again, in our portfolio, if you look at our, 13 brands, I don't know, I need to do the math, but probably 10 brands are American. And those 10 brands are in Mexico. We have Chili's, we have Cheesecake Factory, we have Burger King, we have Domino's, we have Starbucks, and P.F. Chang's, and all of them are successful, Eduardo. Of course, some have more potential than others in terms of the number of units we have. But yeah, definitely, again, we Mexicans love American brands, and that has been the history. Of course, we need also we need to differentiate those brands in the local perception, Eduardo, that it is those brands are run by a Mexican company, that kind of the employees that are kind of running the company are also Mexicans, that are kind of helping the local communities, that we do kind of sustainability. We need to embrace that and also communicate that to the market. Because, well, recently there's been somewhat sometimes a pushback to these type of brands, or basically kind of American offerings. But we also have been proving ourselves that these brands also can travel well, Eduardo. So it is not just Mexico, the market with opportunity, but also other markets. Today I would say the Mexican food is I would say hot out there, and a lot of, I would say, countries will love to have Mexican type of food in these markets, which I would say they don't have kind of a big concept or big unit concept in there.
Correct. No, I mean, before I go into a little bit of a more in-depth question, one of the brand challenges that I think for Alsea, to me at least, seems quite a tall task is opening Starbucks in France, because of the French culture of coffee places, and that's something that you were not inventing like you did in Mexico. So how has it been for you guys dealing with the French and coffee, as they are sometimes quite opposed to the McDonald's, the Starbucks, blah, blah, blah. But that's, I think, a little bit of a myth.
Yeah, no, I would say, Eduardo, since we, let's say, got the operation in 2019, actually, we sent one of our best let's say, people out there. Our current CEO was the one leading France for the last 6 years. So Christian Gurria was the head of France and Benelux for the last 6 years, and now he's currently our CEO. I would say France, it has been a kind of a challenge, Eduardo. We got the company and the operation with a lot of, let's say, low-hanging fruits, Eduardo. So we started to generate positive EBITDA, let's say, a couple of years later after, let's say, our transaction. So we were, and we are, I would say, in the right path to become a stronger brand in France. Today, we operate a little bit more than 250 stores in France. It's already, I would say, a nice number of Starbucks, but we do believe there's a lot of opportunity to continue to grow this brand, Eduardo. You mentioned McDonald's. There's also KFC. There are also brands, American brands in France that have, I would say, been successful out there. I would say France it's a little bit more volatile, I would say, Eduardo, from I would say movements and things that I would say happen almost every 2-3 years. Last year was not the exception. We had the boycott to American brands that I would say was driven by the war in the Middle East. And that impacted our numbers, as well as I would say Starbucks in the Middle East or other markets. But we're recovering from that, Eduardo. We are, I would say, 85% of the transactions pre-boycott levels. So we're getting there. It is a challenge, but we do believe it's a very unique and interesting market where we do believe we can continue to grow and I would say build a strong brand there. There's no, I would say, Eduardo, even though that they have I would say, a stronger coffee culture of cafeterias, there's no, I would say, cafeteria with a very strong position, Eduardo. It's similar. I would say it's similar to Mexico in other aspects, that there's a lot of mom and pops of coffee shops. There's no, I would say, big brand dominating the market. So we want to be that player in France, Eduardo.
Correct. One thing that surprises or amazes me about your operation, Gerardo, is what you were talking before on logistics and supplies. I once even went in another life to your factory in Toluca. I don't know if it's still operating, where you created some of the things that you sell to eat in Starbucks. What can you tell us about that logistic element? Because it's not only Starbucks, it's Domino's, it's Burger King, it's P.F. Chang. And how do you replicate that when you go to other countries? This is something that I think some people don't realize how impressive it is what Alsea has accomplished, not just in Mexico in those terms, but in other countries, becoming a real multinational company.
Yeah, and I think that I mentioned this in one of the first questions from Damien. Our supply chain, for me, it's a differentiator, definitely. We create a lot of value from our supply chain. And as you mentioned, it is not just Starbucks, but it is Alsea. I would say this is across the board. And yes, I would say that the Toluca factory was a small factory for food, Eduardo. And now we have concentrated almost everything in what we called our COA, Centro de Operaciones Alsea. And this is, I would say, outside of Mexico City, in the state of Mexico, in one of the big kind of real estate. I forgot the concept, but yeah, one of the, let's say, warehouses, big concepts of warehouses in the state of Mexico, where when we integrated our distribution center and also our, I would say, manufacturing facility. Because it is not a pure distribution center. We do all the Domino's pizza doughs for all the Domino's pizza system in Mexico. We do the paninis. We cut meats. We do the sauces for the restaurants. We do rice. We do beans. We do a lot of things. And we send that to the stores, again, 2-3 times a week. So that is a differentiator that I would say very few have that type of, kind of scale to do it. How can we replicate that? It's a little bit different, Eduardo. We needed to build that in Mexico because there was no, I would say, third party that can give us the level of service, the level of quality, the scale that we needed. And that was, again, back in the days in Mexico, what we needed to build. In Europe, it's different, Eduardo. We do have some suppliers that I would say are capable to give us what we require in all of our stores. I would say, again, twice or 3 times a week. So we do it through a third party. So it's a little bit different. You need to adapt to the markets where you operate and the brands that you operate. So again, that is probably also some of the successful or the success that we have had in Alsea over the years, that we adapt ourselves to the markets that we enter. It is not the other way around. It is not Alsea where the markets need to adjust how Alsea works. It's okay how Alsea can enter that market in an efficient way, in a productive way. That I would say the stores are the most important assets we have, and the people that operate the stores. So how can we let these people operate the restaurant without, I would say, thinking on, okay, your product will be late or will be whatever. No, they need to operate. They need to serve the clients, the customers, and we do it at the corporate or the central offices. All that type of tasks that, again, let people at the store more efficient.
Gerardo, talking about adapting, I mean, clearly in the last 5 years, during and post-COVID, been a massive increase in digitalization in the restaurant industry and deliveries to your door. And maybe 10 or 15 years ago, Domino's was practically the only way to get food to your house in Mexico. Now there's, through Rappi and Uber Eats and so on, millions of ways of getting any kind of food to your house. How is Alsea in its different brands adapting to this massive change in the way people are going about receiving their food?
Yeah, no, that's a good question, Damien. After the pandemic, again, kind of the aggregators, digital delivery, now are here to stay, right, Damien? And you have seen our numbers from digital growing almost on a double-digit basis for the last 4 years. Today, I would say roughly 35% of our sales are through digital channels. That doesn't mean that it's all delivery. This is also, for example, the digital kiosks for Burger King, or I don't know, people asking for their orders in their app and taking it out and going to the restaurant to take that out. But we've been adapting, I would say, Damien. Before, one of our, I would say, main differentiators, for example, in Domino's Pizza, was a delivery. That was one of the, I would say, unique businesses that had delivery in Mexico. Again, that evolved, and over the past 5 or 10 years, this has been changing. And how we're evolving, and I think you have seen this over Domino's Pizza in the US as well. They are building new relationships. They built a relationship with Uber, now DoorDash. That was a kind of a hot topic in their last earnings call of Domino's Pizza a couple of days ago. And we're doing the same, Damien, here in Mexico, for example. We are partnering with Rappi, with Uber, with Didi. I would say at first, we thought from them like I don't know, they were eating our lunch. They were not here for business. And we have been changing that. We've been changing because we are now working with all of them. We work with them as, I would say, more of I would say kind of an e-commerce platform or a marketplace. We still do a lot of the delivery, for example, for Domino's, but we rely on them in Starbucks and in the other brands where we don't have drivers to do the delivery ourselves. And now I would say with these announcements from Domino's Pizza in the US, we've been also doing this here in Mexico. We also partner with Uber Eats. We are using Uber Direct, that they control all the again, kind of the purchase and the orders. Before, they were the only ones, we were the only ones delivering the pizzas. Today, Uber, it's also helping us. And how is helping us in peak hours, for example, or if it's kind of, I don't know, Mexico, it's playing a match, football match or whatever, and we have a lot of demand, and we don't have enough drivers. Now we can, again, leverage on Uber to help us do that. So we're working on these type of initiatives, Damien, and we never thought that, I don't know, 10-15% of the Starbucks sales are done today through delivery. So we're making, I would say, promotions. We're doing a lot of marketing to have visibility in these platforms. And we will continue to do that because, again, these platforms are here to stay. That these might kind of evolve in the future, but the delivery is here, and we need to participate on that.
And last question from me, at least. You're also head of sustainability, and sustainability obviously has implications for investors. Investors in the past, at least, very focused on companies that have strong ESG commitment, and also for consumers that care about local ingredients or renewable energy or about managing waste. With Trump making it very clear that asset managers in the US shouldn't be focusing on ESG, are you seeing less of an interest in ESG at Alsea? Is it now no longer the priority that it might have been a couple of years ago?
Well, I'm not sure, Damien. We're, let's say, receiving less questions, or I would say the market is less focused on ESG issues, Damien. I would say what I can say here at Alsea, we've been, I would say, recalibrating or kind of adjusting our ESG goals for 2030, 35, and 40 and 2040. And we launched them some weeks ago or a couple of months ago in our annual report that we disclosed at the end of April. We're focusing on ESG because I think it's sustainable for the business. We want to implement and we want to integrate those processes within our brands, within our decision making, to get, I would say, some benefits. Also, I would say economical benefits or financial benefits. We're looking for savings. We're looking for returns on some of these initiatives, and it is not because we are, I would say, willing to communicate or kind of greenwash the market in the way we are kind of working on ESG. It is because we truly believe that if we do these adjustments at the operational level, we'll bring more customers, we'll bring more profitability, we'll bring, again, less harm to our world, etc. So we are working on this because we do believe is the right way to go. In how we are perceiving this from investors, I don't know. I've been with the company for a year and a half ago. So and not a lot of history that I can tell you about kind of the interest from ESG investors. But what I can say about my past experiences, I came from I would say the chemical industrial mining business before, I would say the beverages retail. So coming from, I would say, an industry that was, I would say, in all eyes of ESG, like the chemical or mining, I perceive a little bit less of interest or let's say, less questions regarding ESG. But I'm not sure if it's because the rhetoric outside in the world about less importance of ESG, or if it's because of the industry where I am now kind of working in.
Gerardo, from me, one last question. Any breaking news you can give us in terms of your growth, where you want to be in the future, any new brands that you might bring to Mexico that you're talking to? What can you tell us about the future for Alsea?
Yeah, no, I think we've been communicating our long-term growth plans. One thing, just to make your audience kind of very clear, we don't have yet Chipotles in Mexico. We haven't. We are planning to open our, let's say, first locations in the first half of next year. So stay tuned to where those are going to come from. Yes, again, we are always analyzing our portfolio, Eduardo. We want to have the best brands, and having the best brands also means which brands are not anymore attractive in our existing portfolio. So something that we've been saying, I would say, over the past let's say, couple of years is that divestments will also might come. We sold Burger King in Spain. We've been kind of, let's say again, rationalizing our portfolio in the past years after the pandemic, and this will continue. So also expect to some of our brands to potentially leave our portfolio, and some potential brands to come. There's one category that we're not today, that we want to be a little bit more, I would say, aggressive in, which is the chicken category. Chicken has been one of the, I would say, one of the fastest growing protein outside or in the world in the past years, and we're not directly involved in chicken. So we're analyzing which brands are out there. You might think of 2 or 3 that are very big today in the US that could be potentially in our portfolio. But let's see, this is like M&A. You never know, right? Sometimes you're very close to sign a deal, but sometimes you're very far away to sign it. So that is something that we are always looking at. Our long-term potential, Eduardo, it's to open around 2,000 units over the next, I would say, decade. Eduardo, we want to have around 7,000 units in the next decade. And this is, I would say, primarily driven by organic growth. Continue to grow Starbucks and Domino's primarily, and our, I would say, fast casual dining restaurant segment in Spain and Mexico. Those are, I would say, the main focus. And I would say the U.S. is not in our radar today. I would say maintaining our position in our existing markets. We with our existing brands. It is. I would say that the strategy that we are following in. And again, we might have potential brands coming in the next years.
You give me a few hints. I might be checking on a few chicken companies that I like, and try to break the news before anyone else. But having said that, thank you, Gerardo, for talking with Damien and me. I think, like you said, Alsea is a young but mature company now. It does have that culture of startup-y. I mean, I've been to your office a couple of times, and it does feel like it's always in a move. As a matter of fact, you've moved headquarters from different very interesting buildings in Mexico. So come back to MexMoves. We'd love to continue this conversation with you.
No, thank you, Eduardo. Thank you, Damien, for having me, and it was a pleasure. And yes, prepare for the second part of this conversation, guys.
Sounds good.
If nothing else, Damien, I think that will close down this version of MexMoves. Thanks everyone for listening. Don't forget to subscribe, and we'll be here next week.